Starting off today, we have Mike Mooney. He's the principal and chairman emeritus and co-founder of LMG Capital in Brookfield. So please welcome Mike Mooney.
Good afternoon, everyone. This is my 56th year in real estate. I've had experience in every cotton picking thing you can do in real estate. And I've been a decades-long advocate for what I refer to as life cycle housing. Without using that label, it was touched on in each of the remarks, and I'm especially interested in the comments along the way about young people leaving home and have not being able to afford to stay in the community. When I think of that, I think of the glue that holds communities together, which is continuity. So somebody grows up in the community, they go to school, they build friendships, they get a job in the community, and eventually, if the housing opportunities in the community allow, they'll move out of mom and dad's home and live in an apartment or a very small house or even rent a house, and then eventually maybe they get married and start a household, and they can afford a house this big. And then when their economic wherewithal improves, they add a garage, and later on they add a family room, and they end up with 2, 3, 4 kids. And as time goes by, everybody's happy there, and then those kids are now in the position their parents used to be, and they're looking to move out, but there's nowhere they can afford to live in the community. So they leave. So all of the connections between those individuals and their schoolmates and their athletic teams and the library and the civic center and so on, bang, they're broken. Then each one of the kids follows the same route. And in each loss of those people, the glue of the community is broken. Then ultimately, mom and dad can no longer afford, either financially or physically, to maintain that big house. Now, they are even far more engaged in the community than their kids were. They may be on a hospital board and maybe a county executive or a mayor or an alderman or something, and they can't afford to stay in the community. So there's another fabric of the community that's broken. So we end up with communities that are much more transient than is healthy for the sustainability of the community. And the community loses, the individuals lose, because when those kids moved out to somewhere else, are they likely to come back? Not so. So that's always bugged me. And in 1991, a bright county executive in Waukesha County held a Wisconsin Affordable Housing Summit. And he had national speakers, the Secretary of Interior and so on. And I was asked to speak on a life cycle housing, which I didn't know anything about. But I spent 3 months studying it, and I became completely transfixed with the fundamental element and role that this plays in the health of communities. So over the years, I've made many speeches in many forums around the state on the subject, and not a cotton picking thing has ever improved. But having the opportunity to participate today caused me to dig into a mountain of old papers, and I came up with the report that I submitted to that forum in 1991. And there's only one aspect of this that's no longer sane. And that's the cost factor, because my costs were from 1991. and I'm not a mathematician, so I didn't update those. So if anybody wants one of these, give me your card as you leave today, and I'll be sure to email you a copy. Now, within that document is the second part of what I want to talk about. And each of you should have gotten one of these. It says Sample Affordable Housing Plan. And that was the last 4 pages of my presentation. And in there, it shows a subdivision with smaller lots and modular homes, and everybody wants a sense of having a view. And everybody wants some privacy. Well, this was a development plan created actually 2 years before that by myself and a nationally renowned land planner from Milwaukee named Bill Nelson. And all of those houses are configured so they're either back to back or side by side, and they all have a sense of space. And then there's open spaces throughout the development, and there's extra parking area because the setbacks were small, the side yards were small, the backyards were small. But these were starter homes. And I tried in '92 to get this development approved in the village of Sussex. And when they saw this, they went nuts. I said, I'll bet every single one of you lived in a house. When you moved to Sussex, you lived in a house, no garage, no family room, and then you made it into something else, including all of you on the Planning Commission and the Village Board. But now you want to be Brookfield. Well, not everybody can afford to live in Brookfield. So that's one way to shrink the overall cost, because the land is a big chunk. The second is our staff is full of researchers. And one of these astute researchers did what is labeled life cycle housing, but it's really the cost and finance barriers to workforce housing as it relates to West Bend. And if you look through that, you'll see the absolutely unmistakably clear reality facing people interested in being homeowners or tenants. And as you've heard today, you've heard all sorts of fabulous stuff. I was here probably about 15 minutes after it started. This has been an awesome conference. But there are dozens and dozens of issues that came up in here that all need to be attacked. This is not a simple wave a magic wand over it kind of a situation. It's going to take a lot of guts and a lot of fortitude and a lot of education, both of public officials, state officials, and our populace. Because within MLG, we've done 50-some subdivisions and 20-some business parks. And for probably 3/4 of that, I was the front person in facing the maddening crowd with tar and feathers and pitchforks and so on. It's only gotten worse. And I thought it was bad. But what's missing is their responsibility to tell the truth. If I didn't tell the truth, man, they'd run me out of there on a rail. But those people don't have to do that. The last thing is housing tax credit. Brookfield has gotten, its planning department has gotten wisdom, and my company was one of the front buildings in Bishop's Woods, which was the premier office park in the state of Wisconsin since the 70s. But the buildings in there are no longer feasible to recruit office tenants. They have lots of prospects. Nobody's interested in Bishop's Woods. So this company came out of Illinois and proposed a workforce housing development. And it's a complex funding mechanism, and this is part of it. And I can't give you all of the details because it's very complicated. But through the Wisconsin Housing and Economic Development Association, a company, a developer, could choose one of two types of housing tax credits. You get a 9% credit under the category to the left and a 4% credit in the category to the right. Now, there's a lot more to this, but I think even perusing these simple explanations will help you understand that there are creative ways, many of which exist today, to use, for people to use their heads and really dig in and discover what it is you can do creatively, whether it's as a community or a developer or a builder, to find ways to put together packages that allow people to afford to begin to be homeowners, or in this case of the project in Bishop's Woods, tenants.
Thank you for having me in this and giving me this opportunity to present to you today. I'm delighted and sorry I can't be there in person due to some other commitments, medical commitments that I have. And when I start looking at this, I think the goal here is to how do we build 140,000 new housing units over the coming 7 years? It's about 20,000 units a year. That's historically what we've built before 2007, between 1994 and 2007. But that 20,000 comes in two forms. One, single family, about 14,000, and then about the other 6,000 being a multifamily. A couple of things to start thinking about as we look at this. I trust you've had the opportunity to look at some of the slideshow by Josh Human, and he talks about what they're doing in Washington County with next generation housing. And he's really talking about how do we make housing more affordable for the median household income, which is $85,500 in Washington County. And when we start looking at that, there's a couple of things that are worth noting. If you got $85,000, you take 30% of that affordable house, be it a rental or home ownership, is about $25,600 in payments a year. You subtract out some for insurance and such, and you're down to about $24,000 in payments. And we start looking at that can afford, the individual can afford almost $300,000 in house. Now, a couple of noteworthy things as well. In Washington County, the average household size is 2.43 people. So let's start with that as a context to the following questions. First off, single family, and then some multifamily thoughts on the financing. So Josh does a great job in talking about what municipalities require that add to costs, such as curb and gutter, lot size, house size, and other things that elevate the cost of a house from a regulatory perspective. I would like to also add to that the idea of the time cost to developers. And that time cost is huge. The time cost of getting the approvals, of working with the community, among other things. If you can reduce that time cost, that risk to the developers, they're much more likely to come in. How do we do that? Getting some pre-approved PUD type development. We don't have to have the specific lots in place, but you're approved for this many units and you can build them, and you have your infrastructure coming to that site. That reduces a lot of the upfront risk to getting the development done. Both Josh as well as David Bellman talk about large cost of $80,000 to $85,000 to $90,000 in regulatory costs. Much of that comes in the form of land regulation to get that lot built. So how do we start thinking about this from a municipality's perspective in funding this? So first off, there are some ARPA funds that are maybe a one-time, one-off to help fund some of that. But one other way to look at this is funds from the Board of Commissioners for Public Lands. You can go out and borrow that money. It's a 2-page application process. I sit on their board as an ex officio member. It's a 2-page application process for a municipality to come in and get some borrow some money from the Board of Commissioners to start this development process. I suggest that because after the Great Recession, developers can't get money from banks easily. After the Great Recession, we had significant increase in regulatory costs to banks, as well as other requirements that make it such that banks don't lend on land like they did in the past, and that's not coming back. And so we had to find different sources of that. Let's go to the Board of Commissioners to get that lending done directly to the municipality, and then the municipality can help the developer get through that process. What I'm really looking at here is a municipality partnering with a developer to A, reduce the time to development, and B, provide some of the capital to get that done. I think that's critically important to that process. A second piece here is really the idea about building apartments. We said about 2/3 of home ownership is single family, and about 1/3 in the nation is apartments. And I would ask you in all your communities to think about building apartments. And I know apartments could be a 4-letter word to many of you, but go into your community and go and look at, go and visit, go take a look at one of the 2-bedroom apartments that have been built recently by one of the developers. Many of these are luxury apartments that will pull households out of their existing housing and allow them to age in place. Let me explain that. So when you start looking at housing, multifamily housing in the past, it was that transition period between when you graduated from high school and college and when you finally bought a home. Well, what we now have is, as we start to think about aging in place, now you're 55 or 60, you don't want to have the hassles of owning that home anymore. It's not you only have 1 or 2 people in your household. Like I say, 85% of new housing demand is only 1 to 2 person households in the nation right now. Why do we need a large house to maintain for that 1 to 2 person household? Why not provide quality luxury apartment housing to allow people to age in place? It allows someone not unlike myself to not only stay in the community, but I also then can be part of that community and continue to go to the grocery store, the church, the bar, whatever I like about the community. So I think it's really important that we provide some of that type of housing in the marketplace. So, and I'm going to use Beaumont Place in Whitefish Bay as an example. Barry Mandel built 83 units in Beaumont Place. It's right behind Silver Spring Drive, right by the Sendix. And of those 83, more than half of those units, the people who came into them were from the zip code, the subject property zip code. It was pulling people out of their single family homes, providing that next generation of homeowners to come in and buy those homes behind them. The second piece of this was the idea of aging in place. The average age of those renting those units in Beaumont Place was 61 years when they started leasing originally. That's a really important thing. So for us to think about the development of housing, I think we have to break it into 2 pieces. One, single family, where we've got to reduce those costs up front, not only the specific hard costs, but the cost of getting approvals for land. That's what we need in this state. We're not providing enough platted lots. Let's make that easier. The municipality has to partner in that and has to reduce that risk. And then from there, we also need to continue to build multifamily lots in our communities. Again, thank you for the opportunity to chat with you today. And I'm sorry I couldn't be with you.
Rose Oswald Poles is the leader of the Wisconsin Bankers Association, and her members are the people that loan the money for all these projects. Then we have Mike Thier, who leads the Wisconsin Realtors Association. We have Mike Mooney, of course, from MLG Capital. Josh Shulman, who is the county executive of Washington County, and Adam Tagan, who is the community development officer for the city of Manitowoc. Okay, let's just start. The interest rate environment is not what it was, but inflation was bad. Everybody hated inflation. Now the interest rates have to go up to tackle inflation. But, after the Great Recession, there was this great low interest rate period or no interest rate period, and the housing wasn't built. But now we're faced with this situation. So what are your loan officers telling you about the situation across the state in terms of the desire to build more housing and, the ability to build more housing?
Yeah, certainly. I think Mike mentioned the magic wand earlier in his conversation. It'd be nice to have a magic wand to control the Fed interest rates, right? So as interest rates have gone up in the last year, 18 months, you've seen pretty much a collapse in lending. Borrowing costs are high, whether you're a developer or you're an individual wanting to buy a home. So it has caused, a lot of that business to frankly really pull back. A lot of people, a lot of financial institutions, a lot of my members, have let people go. You've seen reports from mortgage companies that have let hundreds of people go because the situation has changed, almost seemingly overnight. I think, obviously this is all cyclical, right? So the Fed is trying to raise interest rates. Some people say too much, too fast, right? They're not letting time elapse a little bit to see the true effect of their interest rate increases, but nonetheless, they're still charging forward. Certainly the last increase of 25 basis points was a lot better than 75 basis points, which was quite shocking when that happened. So I expect that, we'll continue to see some smaller incremental interest rate increases. I have heard one Fed governor, however, say that by the end of this calendar year, it'll be back down to 3.5%, which would be really shocking and positive, I think, in a lot of ways, if that is indeed going to be true. So, the environment has dramatically changed in that regard. And as you heard from the developers earlier, their borrowing costs have gone up just from the interest side alone. So,
right, but which is the worst enemy, inflation or, higher interest rates? Because higher interest rates slows demand. So.
Right. It depends on who you talk to.
Yeah, right.
The Fed says it's inflation, so they're going to keep pushing forward with increasing rates. A lot of people are concerned that's going to lead to a recession. Obviously, inflation hurts individuals. Their pocketbooks are very much affected by this, which decreases their ability to buy a home, right, if they're still renting right now and wanting to buy a home. We can maybe talk about down payment assistance programs, which play a key role later. But
right, I was going to say, Rose, since you haven't been involved in the conversation here, about this seems to be something that government could help with. There's WIDA, which Mike Mooney referenced, but there's also how can somebody new wants to buy their first house, wants to buy a starter house, and they can't get the down payment together. So, is that something that, the banking community would like to see?
yeah, for sure. Lenders work with a lot of different community groups to help people get into their first home, right? Whether it's counseling agencies, a lot of financial institutions put on home buyer programs themselves to talk about budgeting and things you need to think of. Mortgage insurance premiums is something, hasn't been discussed here yet, but if you're an individual borrowing and you don't have the full 20% down on a home, you're going to have to pay mortgage insurance. So there's a lot of different factors that price into this. Recently, when I spoke last week with a few pretty larger mortgage lenders of my members, they mentioned that Fannie and Freddie, of course, as part of the current Biden administration, has a lot of affordable housing goals. And as part of that, they are creating some metrics that Fannie and Freddie as GSEs have to live by in terms of the number of loans that meet certain criteria. So you're now seeing changes in interest rates where if you had a lower credit score, you maybe didn't have a great debt-to-income ratio. You're seeing some of those interest rates in the last few months actually start to come down for individual borrowers, which I think is helpful. And they are telling me that, realtors have figured this out, lenders have figured this out. So together they're, partnering to try to put some people in homes where there is housing stock. That's obviously what's already talked about.
Right. Now we're going to go to, now the biggest part of the issue, though, is it's old supply and demand. There's not much supply, and demand is still there. And, there's no inventory to speak of. So I mean, it's such a change.
Yeah.
I mean, how are realtors grappling with it?
Well, it's not very well in some markets, but I think take a step back. From a historic standpoint, interest rates are not out of control. I bought my first home in 1981, and it was literally 18.3% or something. But we had a lot to choose from at the time, and that's the big differential. So the Fed's intended purpose to fight inflation by raising the rates at the rate that they have been has had its intended effect. It's dampened demand, but this market's still dominated by a supply problem. And so when you look at different incentive programs, whether they're low-income tax credits or other financing mechanisms, you're still stimulating the demand side, but I still think in this market, the problem is the supply side. And we talked a lot this morning about things we could do to address that, but I think it's important to realize that it is something that we need to kind of incentivize from a regulatory reform standpoint, but it's not just the workforce housing that we focused on today. The housing economy is truly a ladder that you need to feed at all levels. There has to be adequate entry level at a certain price point, moderate level, and an expensive home, because that churning, I think, that Brad talked about is something that makes that market work. And a deficiency in supply at any one of those, it locks people in at where they are. And without that churning, you don't have a vital housing economy.
Right. I think what Mike was getting to, and I don't want to interpret, Mike, you'll get to interpret my interpretation, but I mean, it's like our expectation of the starter home is way out of whack. I mean, it's like, are you kidding me? I mean, what people are thinking they're going to start at is like, well, no, you should, but they can't find what they want to, they can't find the thing that, even that used to be the starter home.
Right, and that's what makes this market so unique. So people I represent, when they take somebody out to show them properties, say they're showing buyers properties, and they get outbid time and time and time again with cash offers that are just off the charts from what the listing price is of that home, pretty soon the consumer's going to say, I don't think my realtor's very good, because they're getting outbid. So what you have is you have buyers way overqualified for houses that, that they watch the, makeover shows on TV and think in 1 hour with enough money, they can renovate a dilapidated home into this beautiful, but actually the marketplace is doing that because there's just nothing out there. And so it really has this adverse effect on certainly portions of our population, and that's a problem. Yeah. It's a distorted market in that sense.
Okay, Adam. So anyway, Manitowoc, having its first subdivision since 2012, and what was described there were, I think, some typical starter homes. Not the square footage is relatively modest. So was that a purposeful strategy? Did you folks say, we got to make it affordable, and so we're going to have a smaller footprint, and we're going to, have something that, people can actually afford?
Mm-hmm. I'll actually give credit to the builder. We did our housing study in 2020, and at that point it set out that there was a need for affordable housing. So as he went through that process, that was his goal, was to try and get something that is affordable, although some would argue 300, I think, is give or take, is what he's looking for. Is that truly affordable, considering in our community technically affordable is 200,000. So that was on the builder. That being said, we're looking all across the board because we are having these pinches. We have people who can afford a $500,000 house. They can't find it, so they're buying a $150,000 house, renovating it, which is then preventing someone who can only afford a $150,000 house. So it's definitely pressure across the board. So I would say one thing that we're trying to do is concentrate on, it's not workforce housing because it's rental. I learned that. But we are concentrating on rental workforce housing, if only so that we can get some more churn, so that we can get people into housing to help take off some of that. And then we're also concentrating on senior affordable housing, so that another option, some people are going to die in the house they're in. However, others, they want to move out, but they don't have that option. So how do we give them an option to move out so that we can bring then that 3 or 4 bedroom home back onto the market, bring in a family, help the overall economy?
Okay, Mr. County Executive, we've talked about elements of your plan before, but on the financing part, there's a clear element that you're trying to say, we're going to make it easier for you to get a house.
Yeah, that's right. When you think about Washington County, the median household income is about $90,000 a year. So if we use the banking standard of 30% of the income, you're talking about $2,250 a month that they can afford, which is where we come very close to that $300,000 number that we're aiming for. Now, I think there's two things you've got to do. You've got to incentivize on the front end, because basically the federal government has walked away from that. We used to have FHA production financing. I would argue Dodd-Frank has made this all much, much, much harder. I think we need to look more at it from a gap financing perspective for developers and builders. Carrying costs, like David was talking about in the last panel, the ideas from, I think you mentioned Wichita and others. That is certainly an area where we need to have influence. But the other side, and I tell my staff this all the time, is while we have to make sure we're hitting every area where there's cost inflation or where there's extra cost for a starter home or what used to be considered a starter home, our focus the whole time has to be on the people, on the buyer. If we're trying to influence housing for these folks, then the people have to come first. And that's how the conversation happens with the developer and the builder and the realtor and the banker and everyone throughout the process. How do we get this young person or this young couple into a home that they can afford? Because ultimately we want the realtor to sell them up next time to a $400,000 or $500,000 home. We want the bank to be able to have that mortgage. The one caution that we've learned as we've gone, and some of our municipal partners, I've got to give a lot of credit for the actual work getting done to Deb Silsky and her team, who works for the county. We identified pretty early in the banking discussion, in the financing discussion, that when you have government involved, I said before, you need a white glove approach. We need as little involvement as necessary, and yet there is some necessary. What I mean by that is, if we get too heavy-handed, so we give the property away for $1, there's two things that are going to happen if you give property away for $1. One, you're going to create equity theft, meaning when they sell that home, there's a market value for that home, even if you took the cost of the property away. So if you flip a home, all of a sudden you sold it to them for $300, but really it's worth $350 because that $50,000 lot cost isn't built in. They could in a week turn around and sell it and pocket $50,000, and we all lose. Secondarily, and maybe more importantly, is that same neighborhood in Jackson, right behind, that's very similar housing to what we're building. We artificially depress their values. Because the assessor is going to come in and say, well, that house sold for $300, so it's worth $300. Well, wait a minute, the ones behind them are 50 years older, and they're at $300. That can't be right. And all of a sudden, we get some appraisers or assessors that start artificially deflating properties. So there absolutely is a place. You need to build in mechanisms on the front end to make sure we're actually providing gap financing. Let the market, the banking market, do what the banking market's going to do. And on the back end, so that we're avoiding equity theft and value depreciation. And it's you got to be hyper involved from the start to the finish, because there's pieces I'm sure we're going to learn after these first rounds of pilot projects. There's going to be more things that we're going to have to put in place to make sure we're as white gloved as we possibly can be.
Right. Okay, Mike Mooney. Capital seeks opportunity, supposedly, right? Right. And government can help make pathways for more opportunity. So, could you build today your vision, your life cycle housing? Just build it, and people would come.
I think so. I'm sure of it.
And so, what's different from when you argued to the government of Sussex about it?
NIMBYs.
Okay, so you would have to build it in a place where there weren't any NIMBYs. Where is that?
I mean, I've endured so much BS over the years that actually hurts the community, which really bugs me and saddens me that the people, let's say the neighbors or others they recruit, come up and do the fire and brimstone thing and send a worthwhile, community benefiting project into the incinerator. And collectively, that's happening numerous times in a single community and thousands of times in many communities. And I think one of the factors, I just briefly touched on, education is needed. What you are all absorbing today, if I could have taken 50 of the lunatic fringe that were in some of the meetings that I've been in and plant them here, they would have been amazed. Because it wouldn't have been a greedy, damn the torpedoes developer giving them this information. It would be sound elected officials and other officials who have no skin in the game telling them all of these things. So somehow we need to come up with, we need to educate the public. And then we need to educate the local government officials who are prone, I've been boosting this project in Bishop's Woods in the city of Brookfield, which is fabulous, and it's absolutely the right thing that ought to happen to this project, that I was a major property owner for 22 years. And if the officials were given the opportunity to, or given the guts to do what they swear to do when they sign up for their job, which is the betterment of the community, instead of saying, these dozen residents here, that's the community I'm going to kiss the butt of. Then the rest of the community loses because he or she got sucked in by all of this damnation. And nobody had the guts in Brookfield to stand up and call these people on their crap. Mm-hmm. And it really saddened me because that was a hell of a project. Sorry.
Right, so, but I think there's a larger thing at work too. There's the expectation of, again, what is the starter house? I think that, again, I think it's just way out of whack. I mean, but people need to be educated about that too, right?
Yes, absolutely.
Hey, as a millennial, I'm just going to defend my generation and say, you all made us this way. Okay? It's not like we walked out of the womb wanting marble countertops, all right? I mean, it's truth be told, we've created this. There's nature and nurture, and there's a little bit of nurture going on. But Mike started earlier on with his presentation talking about why I think it's compelling for millennials and Gen Zers to want to come home. Every community nationwide is facing all the same problems. We are not alone. But if you really want to think about having a family, and you really want to think about a place where you're going to raise your kids, there's no better place to do it than where your parents are, where your family is, where your social network is. You can make the counter argument back to the NIMBY this way, because most of the NIMBYs are people who've been here a long time, baby boomers and the like, and you simply say, listen, look at the demographics, folks. If you don't let the next generation in, who the hell's going to show up in the fire truck or the EMS truck? Who's going to be at your church ushering in the pew? Who's going to be sitting at the civic group meetings that you used to sit at? The answer is nobody. And you all don't have to go far, probably, in your community to find a Rotary Club that's dying or a fire and ambulance service that is looking at full-time or shutting down. Up in the Northwoods, you're talking an hour and a half for some people to get ambulance service and EMS service. So I think there's a really compelling argument, and when people hear it, they get it. Millennials and Gen Zers, where I think the disconnect becomes, is millennials in particular never had the chance to kind of make the next rung in the ladder. And so when one's missing, you got to make this gigantic leap. And what we're doing today is trying to figure out how do we help make that gigantic leap. Well, again, you go back to post-World War II America, we've done it before. Federal government has done it before. Industry has done it before. Now we're talking about local government stepping in. And oh, by the way, in the meantime, we've created a stack of zoning and subdivision regulations that are 1.5 inches thick. And now we got to unwind all of that. Millennials face, I believe, Gen Zers face that is as much of a problem as anything. And we've touched on it, but not really hit the core of the issue. The cost of rent is through the roof. You want to know what stops a millennial from getting a house? There aren't any. You know what else stops a millennial from not getting a house? They can't afford the damn down payment to get the house because they're paying $2,000 a month rent. We've built apartments like crazy in Washington County in the last 5 to 7 years, and the rent is $1,800 to $2,400 a month. You can't find a job. I mean, the type of people that we're talking about, we're not talking about subsidized housing. We're not talking about vouchers. We're not talking about any of those types of things. We're talking about cops. The village president Slinger gives a really articulate story about a cop and a teacher who work in his town that can't afford to live in his town. We're talking about nurses. We're talking about tradesmen, tradeswomen, manufacturing, entry-level workers can't get into entry-level homes. We have created all of this space we can deconstruct it to, and I firmly believe millennials, just like everybody else, they eventually want to have that kid, they want to have that family, and you want to know how to avoid $280 a month or $280 a week at childcare? Live close to mom and dad. And when baby boomers get to the end of their life, who are they going to call and go to? It's the kids.
All right, Rose, you had something you wanted to say?
Yeah, just financial institutions, spend a lot of time talking about financial literacy with kids in schools. They often do sort of real life examples, right? You're going to buy a home, you're going to have this expense, that expense. And, I think more of that needs to happen along the context of perceptions too, right? To bring in the reality, as Josh mentioned. Certainly my daughters grew up in a really nice house with quartz countertops, and, they're like, gee, we'd like to live in this house. So let's go back to the house that I grew up in, right? The, 1,100 square foot ranch that, is on a 2x2 piece of property, and, that's where you start, right? So, we try to educate our own children, but it is true. It is a lot about perspective. People have talked about that throughout the morning here, and changing people's perspectives is extremely hard, especially someone that's 60 or older. So I think you need to start, again, going back and leveraging some of what's already going on with high schoolers in particular, but carry that through into colleges. There's a lot of great financial counseling work that I know is being done at different technical and UW extension schools where there's anything from one-on-one coaching to, group instruction, because that's really the stages of life you really need to get people at to have these conversations so they understand that when I bought my house, it wasn't 18%, but it was 12%. And, you have to normalize all of this and what the first starter house really looks like and how much it costs.
Right. Now, you talked before about realtors and bankers working together. When the interest rates were really high, there were creative loans, right? You could bet on the market, so to speak. And I'm wondering whether those kind of things or government mechanisms to create a pathway for a lower interest rate or a lower entry point, where are those things going? Are those things happening? Does more need to be happening? Does government need to be more involved in helping to make that happen?
Well, I think there's a role, again, in programs like down payment assistance programs, lowering costs of funding. I know I learned, again, just in the last few months, the VA has lowered its funding fees. There are some basis point reductions happening in FHA mortgage insurance premium programs. So I think we're starting to see some of those types of costs go down. I think the more that can be put into down payment assistance programs, the better everyone is. That's really, to the point made earlier, especially today, these young adults are in really expensive, crazy expensive rental units, and they can't save for a down payment, or you have someone that's got a $40,000 job that can't save for a down payment. So those types of programs, I think, is where the government can play a good role.
Mike?
Yes, I agree with that, but I want to reiterate that in this marketplace, the supply side of the equation is where the biggest problem is. And I think until you solve that and focus on that, we can help the demand side, but that doesn't seem to be, even in a rate, raising interest rate environment, that doesn't seem to have dampened demand across most age cohorts. And so, as we look at that, I mean, there's some things that are really important. I think Rose is spot on with the notion of financial literacy. It's not just to teach young kids how to save or how to arrange their finances such that they could buy a home. I think it's true with people who actually think they could afford a house, but they don't know they could afford a house. And this is particularly true when we looked at the black home ownership rates in Wisconsin. And in fact, the numbers I saw is we were the second worst in the country, not the sixth worst in the country. And part of that's intergenerational ownership that builds up within a family, but also the wherewithal of somebody who hasn't been in a family that has marble countertops or something like that needs to be taught or shown the way of how you can actually, with that income, afford a house. So long as we don't get the supply so out of whack like it is today that we can't generate that supply. But once we get there, financial literacy, I think, generationally is really important.
Okay, anybody have any questions out there before we do a wrap-up? Yeah, go ahead.
I struggle with all of a sudden go 20% down yet, and after I've been approved commodity for how many years of buying and selling homes. And then when I put my land development together, I had to put 45% down. So what that does is it wipes out all of my money to go get another project. So why are we having to leverage so much money? The bank doesn't want any risk anymore, it seems like, on some of these things. I understand they got burnt at one point, but when you're a proven commodity, how do we get that down? Because I've shelled out $500,000 to get my development underway, and that's been over a year now, and I still don't have a house in the.
Unfortunately, the financial institutions have regulators, right, who come in and examine them every 18, 24 months, depending on where they're at in a CAMELS rating. And they are very focused on housing, on commercial real estate, when they come in to examine banks. And so they look at underwriting criteria, and they expect, quite honestly, that there's going to be some equity in the project, because if values suddenly plummet, they don't want the lender to be upside down on too much of their portfolio. So I totally hear you, and I think lenders are really sympathetic to that as well. I don't think they love forcing their borrowers to come up with that much money or to buy the mortgage insurance in a home context, or in a builder's case to have 40% equity in a project. They know who they're dealing with. They know that you're a great builder and a responsible borrower. But it doesn't change the fact that when someone comes in from Chicago or Minneapolis or, back during the Great Recession from California to try to examine financial institutions here, that's still unfortunately what they look at.
Well, I think that the bankers remember what happened in the Great Recession,
Well,
right? I mean,
Wisconsin still was somewhat insulated.
Right, but I think bankers are very cognizant of what happened. And they were holding properties and having to get rid of them.
Right.
They really don't want to be in that position again. So there is, the hangover from the Great Recession, we talk about COVID, but man, the hangover from the Great Recession is deep.
Well, and appraisal
your chart
valuations.
is,
Yeah,
off the
appraisal
wall.
valuations play a big role in that too, which Josh mentioned earlier. Deflating neighborhoods, because people are selling homes back then for something less, or land is $1, really it hurts.
Okay, here's a question from the audience. Can you address the fact that renters can't be approved for a mortgage with a monthly payment for more than $1,200, but are currently successful paying $1,600 for rent? So, okay.
No, I can't.
It may be related to her individual situation, but at any rate, I guess this goes to the high rent and not being able to save enough to do the deal to get your first house, right?
Yeah, I mean, that all deals with debt-to-income ratios, right? And, you know, when you're selling a loan, which most financial institutions do, to a secondary market investor, they've got requirements on your debt-to-income ratios. And while they obviously are making their payments right now in the rental situation, you know, it's math. So I don't have a better answer than that. I'm sorry.
A local bank, that's not the case. And you remember that the regulators coming out of the Great Recession, this more impacted builders, but they turned real estate holdings in a bank as a toxic holding. And when you do that, the bank reacts to kind of, say we can't have X amount of percentage in our portfolio, even to sell in the secondary market at any given time, because regulators are considering it toxic. You've got to.
Well, and again, it goes to perception too, right? If you're looking at a 30-year fixed rate mortgage, the bank is selling that off to a secondary market investor that has requirements. If you're willing to do a 3 or a 5-year ARM loan, that means the bank is keeping the loan on their own portfolio. They might be a little more willing to work with you in your DTI levels. And that's often, the case. But, whether that can help their